Assalamualaikum and hi everyone. We are from Group 7. We will present about auditing equity. This is the list of group members. Firstly, Nushrafika will present subtopic 7.2. Second, Durga. Third one is Nurul Aisha. And lastly, Muhammad Arif Hakimi. My name is Nurul Aisha. Today I will discuss the nature of equities. Equity represents the ownership capital in a company. This means that shareholders have certain rights, including voting rights and receiving dividends, which may vary depending on the company's performance. Equity is also known as the residual claim on assets after all liabilities are settled. In other words, once a company pays its debt, the remaining assets belong to the shareholders. When we talk about equity, we need to understand its key characteristics, the different types of equities, how they appear in financial reports, and their nature in auditing. Now let's move on to the types of equities. First, we have ordinary shares. These shares usually carry voting rights and provide variable dividends. The amount of dividends depends on the company's profits. Second, we have preference shares. These shareholders get priority for dividend payments and repayment if the company is liquidated. However, their voting rights are usually limited. Finally, we have retained earnings. This is part of equity that comes from profits kept within the business instead of being paid out as dividend. Retained earnings are important because they allow the company to reinvest in growth and expansion. Equities also play an important role in financial reporting. They are represented in the statement of financial position under several categories. The first is share capital, which includes ordinary and preference shares issued by the company. The second is share premium, which is the additional amount paid by investors above the nominal value of shares. The third is reserve, such as revaluation reserve, retained earnings, and general reserve. Lastly, we have other comprehensive income, which records items that are not part of regular profit, such as foreign currency translation or changes in asset value. Together, these components reflect the ownership interests of shareholders in the company. Lastly, for my part, nature in context of auditing context, equity needs to be verified for proper authorization, valuation, and disclosure. For investment context, equity represents ownership and potential return, but with greater risk compared to the debt instrument. That's all from me. I will pass to the next presenter.
And now I want to present about the cycle of auditing equity. The cycle begins with planning and understanding. That means the auditor starts by planning and understanding the company and its equity transaction. After that is risk assessment. The auditor looks at possible risks of error or fraud in equity balance. The next stage of the cycle is internal control evaluation. The auditor checks how strong the company's internal control are in recording equity. Following this, we move on to substantive audit procedure. The auditor tests details like share capital, retained earnings, and dividend payments. Then, the process goes to analytical procedure. The auditor compares equity balance with last year or expected figures to find unusual changes. Next is audit evidence gathering. The auditor collects proof such as bank receipt, bank statements, and board minutes. Finally, the cycle ends with conclusion and reporting. The auditor makes a conclusion and gives the audit report on equity. And now I want to present about the cycle of auditing equity. The cycle begins with planning and understanding. That means the auditor starts by planning and understanding the company and its equity transaction. After that is risk assessment. The auditor looks at possible risks of error or fraud in equity balance. The next stage of the cycle is internal control evaluation. The auditor checks how strong the company's internal control are in recording equity. Following this, we move on to substantive audit procedure. The auditor tests details like share capital, retained earnings, and dividend payments. Then, the process goes to analytical procedure. The auditor compares equity balance with last year or expected figures to find unusual changes. Next is audit evidence gathering. The auditor collects proof such as bank receipt, bank statements, and board minutes. Finally, the cycle ends with conclusion and reporting. The auditor makes a conclusion and gives the audit report on equity. The next slide is audit assertion and accounting treatment. The first is valuation and measurement. Equity balance like share capital, premium, retained earnings are recorded at the correct amount. Then right and obligations. Shareholders have legal rights to the equity. Company does not record equity it does not own. After that is completeness. All equity transactions such as issue of share, dividend are fully recorded. Next is existence. Share and equity reported truly exist and are issued by the company. The last one is presentation and disclose. Equity is properly classified and disclosed in line with accounting standard. Examples, statement of changes in equity. Okay, this is accounting treatment related to auditing equity. Okay, first, share premium. Any excess above par value is credited to share premium account. For example, share sold at RM1.50, extra 50 cent goes to share premium. Next is retained earnings. Profit are accumulated here and dividends reduce retained earnings. Then dividends. Recognized as liability only when officially declared or approved by the board, otherwise disclosed in notes. Next is other reserve. Includes revaluation, translation, or fair value reserve recognized per accounting standard. Lastly, share capital, recorded at nominal or par value when shares are issued.
7.3 Provide the discussion on relating accounting system and control activities related to equity. For accounting system, companies use the equity method of accounting to report their investment in other entities where they have significant influence but not a controlling interest. For initial recognitions, its equity method investment at cost and present it as a single amount on its balance sheet. Transaction must be supported by proper documentations, and an investor ownership percentage or degree of influence may change for many reasons. Thus, a purchase or sale of equity ownership interest by the investor or the investee is the most common. For control activities, the first point is control of share capital transaction by the board of directors. All changes in share capital account should receive formal advance approval by the board of directors. The second point is the proper authorization of transaction by the board of directors and corporate office. The third point is the maintenance of adequate records. The fourth point is internal control over other debts. The acquisition and repayment of capital is sometimes referred to as the financing cycle. The fifth point is internal control over account payable. The terms account payable, often referred to as voucher payable for a voucher system, is used to describe short-term obligation arising from the purchase of goods and service in the ordinary course of business. The last one is segregation of duty between approving equity movement and reconciling balance. It is for reduce fraud risk and ensures accountability.
Good day to everyone. My name is Durga and my matrix number is 06D8023F1029. Today I'm going to present on how to apply the audit procedure by evaluating the evidence provided. So there are totally 4 procedures, which is make sure the share really exists. Auditor needs to check share certificate and the company registration. They need to confirm that the shares were properly approved by the company. Second procedure will be check if all equity is recorded. They need to look at the meeting minutes to see if the company issued new shares or paid dividends. Make sure nothing is left out. The third procedure will be check the amount. We need to recalculate the total share capital and confirm that profits and dividends are recorded correctly. At last, check how it is shown in the financial statement. Make sure the equity is in the right place in the balance sheet.
That's all from us. Thank you.